Good afternoon, ladies and gentlemen. As Viv said, my name's Steve Fletcher, and on behalf of all of the team at GSFM, and also on behalf of the team at Munro Partners, I'd like to welcome you all to the Munro webinar today. First and foremost, we hope you're all well and managing this challenging period as we work our way through the pandemic and what have been extremely volatile and difficult financial market conditions. The webinar today will run for approximately 30 minutes and will then take your questions. You can submit those questions at any time during the presentation by simply typing your question in the questions box provided on your screen. We have today on the webinar Nick Griffin. Nick is a founding partner and chief investment officer at Munro Partners. Many of you know Nick well and recently attended the Munro National Roadshow across all the major capital cities just back in February. Now, the goal of the presentation today is to provide you with an update on how both the Munro portfolios have fared over the March quarter. Those of you who attended the roadshow would remember we announced the addition of a new long-only fund, the Munro Concentrated Global Growth Fund, designed for investors who have a relative return focus. This concentrated fund complements the flagship long-short fund, the fund that most of you are using today. Nick's track record in managing this long-short investment strategy is now approaching 15 years. And as he describes, this fund is designed for investors who have the objective of achieving meaningful absolute returns with a capital preservation mindset. So what we're going to do today is look at both the funds, but in particular, take a close look at the flagship long-short Munro Global Growth Fund. We'll look at how the capital preservation tools were implemented and assess their effectiveness over the March quarter. Now, in addition to this, Nick will talk about his view of the world as we work through the pandemic and subsequent economic shutdown. He will discuss where to from here in equity markets and outline how the Munro Global Growth Fund is currently positioned. So ladies and gentlemen, with that, what I'd like to do now is hand you over to Nick Griffin. Thanks very much, Nick.
Yeah, thanks very much, Steve, and thanks very much for everyone dialing in. I recognise you've been on a few of these, so we'll try and keep this one fairly brief today. Look, the first thing is obviously just a disclaimer. Look, this is a webinar, so we have probably a few new people on the webinar. Today we are giving general advice. We're not giving specific advice. We're not licensed to do that, and so all of my comments are for general advice only. Please take your time to read the disclaimer after the presentation. Yeah, so the first thing we're going to do here, as Steve said, is we do this normally every quarter. We're just going to run through the first quarter and how the fund performed in the first quarter, what went right, what went wrong. Then we're going to roll on to talk about our views on what's on the months ahead and how we're going to position the fund to deal with whatever may be coming next. Look, the first slide I'm going to start with is this one, because a lot of you who maybe saw me in January probably February saw me present this slide. And this slide was showing you global OECD GDP over the last 25 years. And what it was designed to say was to say, look, these big drawdowns in OECD GDP are actually very rare. And that people will often try to tell you that everything's going to be terrible, but in the end, it's probably going to be okay. And the reason why I'm showing this slide is because it was 100% wrong. We did not see this coming. This is one of these things that come along, and when they do come along, you never see them coming. And ultimately, unfortunately, as it became clear throughout the late February and early into March, that things would actually not be okay. And that our worst fears would actually be realised. So this is a slide that is essentially the tracking of the virus cases. I'm sure you've all seen a version now. I think we're all familiar with flattening the curve. This is one produced by Hayden and our team. And actually what I'm showing you here is what we published on the 11th of March on Livewire, and something we'd been tracking previously. And so what became clear to us after tracking the virus through China and dismissing it, as it started to come through Italy, it started to become clear that this was actually going to become a much bigger problem. Now, what you all know about the Munro Global Growth Fund, and just as a reminder, it is our flagship product. It is an absolute return product. And so what it does is it's an equity product, like most equity products. And so it does this stuff in white, which is that we have an investment team that follows an investment process that picks stocks. And ultimately, we pick those stocks with high conviction. We happen to be a growth equity manager. Lots of people are value only managers. So we've done that for as Steve said, for roughly 15 years. But what we also have is this stuff in yellow. And so these are our capital protection tools. These are the things that are there designed to help give you that absolute returns through that cycle, or that capital preservation mindset that Steve talked about. And the first and biggest one is obviously cash. The second one is option hedging or put option protection. The third one is our ability to short sell. And fourth and most importantly is stop losses or our capital preservation mindset. And so obviously all this stuff in yellow was deeply required through the March quarter, and that's what we're going to talk a little bit about now. So on this slide, and again, it's a slide I show most quarters, and I think you're all pretty familiar with it now, or at least familiar with what happened in the March quarter. Look, it was a difficult period for markets. Most markets fell more than 20% around the world. Worst quarter since 1987. On the far right-hand side, we're actually showing you what the index did in local currency returns, which had actually lost nearly more than 20%. It's important to recognise that the Aussie dollar did buffet the global index as quite significantly, i.e. the fall in the Aussie dollar buffeted. Indexes are down around 10, and on the far right is the return of the fund. What you can see is that we actually achieved a small positive return on our equity investments, and that with the currency gains achieved a 7.6% positive return for the quarter. And so we'll now just go into a little bit more detail as to how we achieve that, which will ultimately just give you colour as to how we run the product and how we'll run it going forward as well. And so what I'm delving into now here is these are the returns of the Munro Global Growth Fund. So this is the 7.6% split by category or by, say, asset class within the Munro Global Growth Fund. Excuse me. And what you can see is that long equity returns, like everyone else, was negative. Okay, markets were negative. Most stocks we held went down. Roughly 12.6% was the loss on our long equity portfolio. So it was a lot less than the index, mainly because of the things like Amazon and Microsoft, which were big positions in the fund, but also because we observed our stop losses on things like Airbus or some of our luxury good companies, which we sold quite early on in the sell-off. And so we did have some cash through that first quarter. But what you'll see on the right is the things that offset the losses was obviously the short equity returns. So shorts added 6.4% to return during the quarter. And our hedging returns, so these are things like put options or futures that we basically use to hedge the underlying long-only portfolio, added 6.7% return. And then foreign exchange added 7.1% return. So like the index we gained from FX, not as much because we only had a roughly 55-60% US dollars through the period, and the index is more 100% hedged. So we were still running some hedging through that first quarter. Look, on this next slide, we're just going to show you a bit more detail behind each of those categories. So we're sort of going to lift the kimono a little bit on sort of what we're doing here. And I think the key message I want to put through here is this is very, very vanilla what we're doing. It's not fairly complicated stuff. On the left-hand side are the top 5 long contributors to performance for the quarter and the bottom 5 long detractors. And what you'll see is we did actually have some stocks that were positive for the quarter, Amazon being the obvious one, and other things that we sold either on a stop loss fall from peak that didn't actually detract from the quarter like they otherwise could have. At the bottom, we had some long-only detractors. I think these companies were really the things that were most in the blast zone of the virus as it became clear that this was going to become a big issue. Uber's an obvious one, Montclair and luxury goods, Stryker, elective healthcare company. On the right-hand side, we have the contributors on the short side. So the top 5 contributors on the short side. And I think the key thing to flag here is the top 4 of these we already had on going into the crisis. So our negative views on these companies were actually much more structural, oil and gas, Harley Davidson and autos, Swatch and watches, etc. So those top 4 were more structural. We did push them harder through the quarter, but they're already on. We then also added banks about halfway through the quarter because they're the obvious companies that will suffer in this environment. And the last thing down the bottom is the put options. As many of you know, we've spent money on put options pretty much consistently for the last 3.5 years to protect the underlying portfolio. And ultimately, this was the payoff of doing that over a long period. And so what you'll see is put options on the February S&P, but we also rolled them into March. We had Japan put options on, and we also had futures on. The last one there is the HYG. That's a high yield index in the US, an ETF, and we had put options on that. And so all of those paid off quite well for us. Last thing to flag is that all of those hedgings are now closed. They were all closed during the March quarter, and so all of that money is effectively in the bank. And on the short side, roughly half of those are closed now also. Look, last slide I was just going to show here is look, this is how it looked in real time for the fund. So this is the net equity exposure of the fund since inception back in August 2016. And so as you see, we try to stay reasonably fully invested, sort of 70 to 80% invested is the net exposure. The gross exposure is over 100. The exposure dropped very quickly in late February, March. That's really those put options exploding in value. So it creates this delta adjusted effect on the portfolio. They turn into synthetic shorts. But we also did, as I said, increase our short exposure, and we did observe some stop losses. Lastly, as I said, look, we have closed most of that in the back end of March. And so it's hard to see on this slide because it's a 10-day rolling average. But the quarter did finish with the net exposure at roughly 51%. And that consists of 65% long and 14% short. And so the long book actually did not turn over much here at all. Apart from the things we stopped out of, we kept everything roughly the same. It really was just hedging that did this. And so from that point of view, we now finished the quarter into the next quarter, significantly more invested than we were through March and February, but still not fully invested. So we've sort of got a foot in each camp at this point in time. Look, the last thing I'd say is clearly we've done this not with $20 or $30 million under management. We've done this with $1 billion under management. And so the liquidity of the fund was super important here, and its ability to be liquid through this period was super important. We'll talk a bit more about that in a second. So that's the March quarter. So now I'm just going to quickly talk about where we go from here. Clearly, there's a lot of uncertainty. So there's going to be a lot of observations here, but then the positioning will be much clearer. But from that point of view, look, where does this evolve from here? So the first thing we can say is, okay, we're now all familiar with these virus cases charts. We make them logarithmic now to make them look a bit flatter. I'm actually not going to get involved in this debate. I'm sure that a lot of you have become epidemic or infectious diseases experts over the last month, as have we. The reality is the curve is flattening, and that is positive. But how we evolve from this is the thing that's, I think, a bigger question. And so on the right, I just want to make two points that I think are somewhat unescapable. The first is that most people do not want to get COVID-19. For a long time there, I was desperately hoping that Tom Hanks or Boris Johnson would come on TV and tell you that it's not that bad. But that's not the case, okay? This is a dangerous virus. It is a flu. People do not want to get it. The second thing to say is for now, social distancing is our only health defense. There are defenses out there, but they seem to be a long way away. And so this social distancing thing is probably going to be with us for a little while. What we now know, and on this next slide, is governments have reacted to try and build the bridge across the valley for businesses, okay? So we have seen a huge reaction to the COVID-19 spread, which has come from these lockdowns, and then a huge government reaction to it. And so what I'm going to try and do now is just put that together into a view for the economy and the portfolio. And the first thing is I'm showing you here is the stimulus. So the stimulus is big. It's really big. There is literally no moral hazard here. It's no one's fault that this has happened. And so governments are putting in a lot of money. And these are some of the biggest stimuluses we've ever seen. And I think they will get bigger. The government will keep putting the money in, again, as I said, because there's no moral hazard here. And I think as Josh Frydenberg says, he describes it quite well. They're trying to build a bridge across the valley to try and get your business from one side to the other. But I think the key point to make here is this isn't actually stimulus. It's compensation. It's compensation for earnings that you've lost because you've been forced to shut down while a health crisis went on. And so ultimately, all the money that comes in is probably not going to be enough to replace the money that's lost. So this is it's a net negative. It's helpful, but it's not going to save you from a recession on the other side. The second thing to point out on the stimulus is just here we're showing you what the central banks are doing. So on the left, we're looking at the Federal Reserve balance sheet versus the US S&P over time. And on the right, we're looking at US jobless claims versus the US S&P inverted. And so we're saying which one outweighs. And so obviously the Fed and central banks are doing everything they can to provide liquidity to the market, to provide the ability to access capital. But the problem is not liquidity, the problem is solvency. So on the right, you have these huge jobless claims that far outweigh anything we saw in the financial crisis. And so from that point of view, you can make money as cheap as you want. It's not really going to solve the problem for the economy here, because the economy is the problem is solvency. It'll loosen the blow, but it won't solve it. And yeah, so that's our key point here, I suppose. This is not a liquidity crisis, it's a solvency crisis, okay? So from that point of view, the reality is the bridge is long, and the bridge might have to be longer, but not everyone is going to get across the bridge to the valley on the other side. And a lot of people are going to need capital, and there are consequences of that. And so on the right-hand side, we're showing you a number of companies that have already tapped the market. It's very prevalent here in Australia, but it is also happening overseas. And they're tapping the market because they need equity. And that ultimately put pressures on the equity market, and it sucks up capital. And that's what the equity market is here to do. But it does stop the equity market rising too much. The other slide I just show on the left is a bit of a lesson to remind people is that it's important to remember that as shareholders, we are the last people that anyone is thinking about right now, okay? These bailouts are to save jobs. These bailouts are to save businesses. They're not there to save shareholders. This is a good example from the last crisis. I'm showing the blue line is the share price of Royal Bank of Scotland over the 2008 financial crisis, and the dark blue line is its market cap. And so what you'll see is that Royal Bank of Scotland needed a bailout. They bailed it out because they wanted to keep it open. And if you go back to the UK, it's still open today. But the bailout was hugely dilutionary to shareholders. And so while the market cap of Royal Bank of Scotland has recovered since the crisis, the shareholders haven't, and they never will. And so from that point of view, balance sheet is everything in this crisis. If you don't have the money to get through across that bridge, and you need to raise capital, don't expect it to be on very good terms. And so from that point of view, that's very difficult for the companies that have poor balance sheets. And that's really a lesson to avoid the blast zone of this crisis. And we'll talk about that a bit more in a second. The second thing I'd also say is as we get through the other side of this crisis, there's going to be huge consequences for balance sheets going forward. So buybacks, dividends, you're already seeing this with the banks in Australia. Maybe they can pay a dividend, but they're getting encouraged not to. And so it's just important to remember that shareholders are not the people with the problem here. It's a health crisis, it's a solvency crisis for small businesses, and so shareholders are probably going to have to pay their bit. And that's some of the examples where that could happen. The last thing, and is really the million-dollar question, is so how big a bridge do we need? How big is the bridge? And I suppose this is the reason why we're still a little bit conservative, because the reality is we just don't know how big the bridge is going to be. We're not experts here. And I think the best way to think about this, if I was to simplify it for you, is to think about how long is it going to be before I'm back at the MCG watching my beloved Collingwood lose another grand final. That's sort of normality to me, because I'm used to seeing Collingwood lose grand finals. And so from that point of view, you've got to think about how far away that normality is. And so from that point of view, every month we're shut down, we lose roughly 2% of GDP. And when we get back going again, we only get about 1.5% back. And so think about it simply. I'm not driving my car right now. I'm not going to drive it twice as much when we get back. I'm not going to restaurants. I'm not going to go twice as much when we get back. There's not going to be 2 footy seasons next year. There's only going to be 1 if we're lucky. And so from that point of view, if you don't know how deep this is, then you don't know how deep the recession is going to be. And so that's sort of probably why we're staying just a little bit conservative at the moment. Last thing I'd just show you is so what's it going to look like on the other side? We do have some data we can use. We can use the Chinese data, whether you believe it or not, but here's some good data from Bernstein, which basically shows coal consumption over the last, through the crisis, or refinery runs through the crisis, or migration data through the crisis. And on the right, you're seeing some comments from some US companies that basically flag that, the Chinese economy is 80 to 90% back up and running. 90% of Starbucks stores are now open. Nike is seeing sort of flat revenue growth year on year this quarter. But I think the interesting one there is the subway rides. Subway rides are still only back to 40% of where they were previously. And so from that point of view, it does look to us like the Chinese are still exercising some social distancing. And so from that point of view, yes, there is another side to this. The economy will get back going, but it might not be the same as what it was. Look, the last thing I would just flag here is, and it's a pretty simple and obvious point, but this does feel like a bear market. On the left-hand side, I'm showing you the S&P 500 over the COVID-19 crisis, and we've just overlaid it on the GFC. This will be my 3rd bear market, and I'm just passing on lessons that I learned from people who told me about bear markets before them. Bear markets just have a habit of making you look really stupid. You can buy one day and the market's up, and then the next day it's going to be down a lot. And we're sort of in that phase at the moment. It doesn't necessarily mean the market hasn't already bottomed. Maybe it has. But what I'm saying here is I expect volatility to continue for a little while. And so from that point of view, we have gone from virtually flat invested to 50% invested. So we do think there's a good opportunity to buy things here. We're just being a bit prudent about being fully invested because these things generally drag out for a while. The last thing I'd say on the right, and again, it's a very simple point, is bull markets last a long time, much longer than bear markets. And they make you look like geniuses. And so all we're showing you here is that even if you bought the last bull market 3 months after the bottom, you know, there were still handsome returns to be made. And so from our point of view, the trick here is to not suffer from FOMO. The trick here is to be prudent and to be patient, because ultimately the bull market will come back and ultimately, you know, there'll be good times to be had again. And our job is to just get you through to the other side at this point in time. Last slide, just to give you a couple of quick indicators here. Look, ask for some market timing indicators. The one that we quite like is the VIX, which is the volatility index in the US. So when would be a good time to go fully invested? Generally when volatility passes. So the VIX had got to 80 in this crisis. It's been 80 once before in my lifetime, which is back in the financial crisis. And yeah, it took nearly 7 or 8 months to get back below 40, as we're showing at the bottom there. And what we're showing you on the left is your hit rate of buying when the VIX is 80 is quite good. On a 300-day view, it's just not great on a 100-day view. And so our view would be just wait for the volatility to subside and your hit rate is much better. Yes, you'll give up a bit of relative returns, but we're about absolute returns here. And ultimately, as I said, the bull market or the next bull market will hopefully be long and fruitful for us all. And so that's just a good indicator of something that we would use. Okay, so lastly, where would we invest? And so this is the fund as it is positioned as of the 31st of March. We're showing you our weights by different areas of interest, the number of holdings and indicative stock positions. And so from our point of view, we want to focus on companies that will be better off on the other side of this crisis. Sure, some of them might take a hit this year, but we want to see who's better off over the next 3 to 5 years. Many of you have heard me say this over and over again. Earnings growth drives stock prices. Every single company on this slide, we think its earnings will grow over the next 3 to 5 years. And first and foremost is the digital enterprise. And so here we've got Microsoft and our other software companies. We've talked about them a lot. We've already positioned them and going into this. If anything, the shift to the cloud will accelerate from here. I think we're all getting used to Microsoft Teams. All of our children are moving to online learning. And so the shift to the cloud, the shift to software will accelerate. E-commerce is the same. We've always thought you'd shift to e-commerce. If anything, this crisis means you shift faster. And so from that point of view, Amazon and Alibaba are still good. Digital payments will take a hit this year because commerce is slower, but ultimately the shift to digital will accelerate here. Partly because you're going out less, and second, because cash is not necessarily hygienic anymore. Digital advertising, so Google and Facebook, again, will take a hit this year, but again, we expect it to accelerate over the long run. High performance computing, semiconductors. Okay, so if there's one thing I know about COVID-19, it gets solved with technology. The social distancing issue will be solved with technology. It will be solved with the Internet of Things, and it'll be solved with the cloud. And semiconductors are effectively the weapons manufacturers in the war here. And lastly, you know, the healthcare companies, diagnostics. Clearly, we're going to have to be more prepared on the other side of this. All of these companies were in the fund before the crisis hit. So all of these we had strong structural views on before the crisis hit. If anything, we are happier now than we were pre the crisis. And so we think their outlook actually looks better. The things that have left the fund is clearly aerospace. We got triggered on quite early and sold very early. Also with luxury goods, we got triggered on and sold quite early. The only other area that's left is really some of our climate change investments. We were very excited about these companies, but the reality is if you want to hit your CO2 goals now, it is much easier because your business is 10 to 20% smaller. And so while we still like those companies a lot, the incentive to invest in decarbonisation is reduced. It just is. And so we're just putting them to the sidelines for the next 12 months. Where wouldn't we invest? So this is just a slide of some of the things that we were short selling and things we would look to avoid. So energy, we were short. What we thought would happen in 18 months happened in 3 weeks. We have closed out those positions. We still think it's challenged, but we wouldn't be either long or short there. Tourism, leisure, the same. We still think it's challenged. It's probably a great opportunity for the value managers, and they're very good at digging around that, but it's not something we're going to be doing. Media with the advertising agencies, again, you know, it happened very quickly. We've closed them out. Look, the areas we're focused on, and I think something to think about here is unfortunately, this crisis has actually just made the big companies stronger. So those big tech companies have the best balance sheets. And if anything, we need them more now than we did before. And unfortunately, Main Street or small businesses or individuals are the ones who are going to suffer here the most. And so there was this structural shift occurring, and it's now happening faster. And so it's the Main Street guys that are suffering. And so ultimately that affects financials, which is an area that we have some selective shorts on at the moment. But it also affects things like restaurants where they use franchisees. Unfortunately, these franchisees are going to get themselves into trouble, and the restaurant labels will have to bail them out. And finally, autos, they have dealers. The car companies are going to have to bail those guys out as well. And so that Main Street evolution is going to take a long time. And so these are some of the areas that we still think are challenged over the medium term. But as I said, most of the shorts, or at least half the shorts, have been closed. Okay, just to finish up, this is the fund as it finished March. As I said before, 51% exposed. We have taken the opportunity to hedge more currency. So we are 65% hedged the Aussie dollar and only 35% US dollars. The top 5 positions are exactly the same as they were going into the crisis. In fact, we barely touched these. We do hold more cash, but that's mainly out of prudence. We have been buying these stocks through the last 3 weeks, and we do still like them on a medium-term view here. So the cash is really just out of prudence here. Slide 24. So this is the performance of the fund since inception. Very busy slide. I've shown this a lot. The key thing for us is to focus on that performance per annum, that 13.2%. We've always said in every meeting I've been to is just to really focus on that absolute return through the cycle. Our goal is to make it meaningfully positive. I've said things like double digit before. Those are the aspirational targets we're after. And if you keep it at that number through the cycle, then generally it's going to work out. And we're doing that obviously with a lower beta. And the last slide here, I'm just going to show just as an example, just to sort of summarize that, is we are actually at this unique point. And so we know the clock never stops, okay? So unfortunately, our job is constant. But we are at this point today where the fund is nearly 4 years old. So we're 4 years old in the Munro Global Growth Fund. And it has been through a bull market and it has been through a bear market. So it has been through an investment cycle. And as we look at each of these areas that we focus on, whether it's long equity, short equity, hedging or currency, they've all positively contributed to create the 58% return for the fund, which is better than the double digit we're after. And it is also better than the index at this point in time. And so that is what happens over a full cycle. Now, all of these things create a drag at different points, but ultimately over the full cycle, it worked out. And so for those of you who've been with us through the full cycle, thank you very much for your support. And for those of us who have been watching, this is a good example of how we'd like it to work out. Look, a lot of things went right, a lot of things went wrong. But ultimately over the cycle, it's achieved what we wanted. And I was joking with Steve earlier that I now am not going to show relative returns for another 4 years, if that's okay with you, but we'll see if I get away with that one. Lastly, just to talk about, so that's the Munro Global Growth Fund. Very quickly, just to talk about the long-only product. So this is just our fully invested relative return fund, unhedged through the cycle. This is the product we launched at the end of last year. Obviously, sorry, runs at a beta slightly higher than the absolute return product. It's clearly just the white stuff we do, so it doesn't have the capital protection tool, but it does have the stop losses. This is the fund as it finished the end of March. So, you know, if you want to be more aggressive, this is probably the product for you. As you can see, we have stopped ourselves out of some of these things like Airbus and luxury goods in this fund. So we've observed the stop losses and we've just put it more into those top 5 positions. So it's just more exposed to the things we really like at the moment. It too has performed quite well, relatively. And from that point of view, really that's a function of A, those big tech companies being more protected here, and B, the currency. It got the full benefit of the weakened currency. Look, last slide just to conclude, and we've got it done in 30 minutes. Look, just to summarize everything I just went through. Like, so from our point of view, it was a good result for the March quarter. It's clearly not a time for celebrating, but it is a time to recognise and to have some satisfaction for the team that the product did what it said on the tin. And I should probably pause here and thank the rest of the team, the rest of the investment team for obviously staying disciplined what was through a difficult period. And also thank you to the operations team in particular. It's important to flag that it's a big product and it stayed liquid the entire way through this. Daily pricing continued to be achieved. Buy, sell spreads continued to stay the same. And so thank you very much to the operations team and the investment team in what was clearly a pretty stressful period for us all. The second point is the most important one. Look, we did not see this coming, okay? So a virus developing from bats in Wuhan that would infect the world and keep us all trapped at home was not in my outlook statement for 2020, okay? You do not see these things coming. The product is successful because it's liquid. The product is successful because it has a mandate that allows it to do these things like hold more cash or these things like buy put options. And lastly, the product has been successful because of the discipline around our ability to do that. And so that discipline has been developed over a long period of time. And so from that point of view, as I said, there is some satisfaction that it did do what it said it would do on the tin. From our point of view going forward, look, it's a capital preservation mindset still as the path clears. So we are more invested than we were before. As I said, we were running this closer to flat in March. We are now 50% invested. So we do think there is good opportunities here, and there will be even better opportunities ahead as the path clears. Look, the underlying portfolio or AIs of e-commerce and software and healthcare and semiconductors will prosper here. It's a sad fact, but big business is better off here. Big business has the balance sheet to get through, and big business has positioned itself structurally to benefit from what has happened here. And so from that point of view, we do think those companies will prosper. And look, lastly, it's important to remember it's not a financial crisis like it was last time. It's a health crisis and a solvency crisis for many businesses around the world. And so look, our thoughts are with them, and our thoughts are with some of these small businesses. It is quite sad to see what's going on here. But from our point of view, our job here is to invest your money accordingly, to give you the best returns possible. And ultimately what you do with those returns is up to you. But it is important to recognize that shareholders are probably not the main focus here for a little while. And so ultimately that's why we're just being a little bit patient in the medium term. So I'll finish with that, Fletch, and happy to take some questions here as they come through.
Yep, terrific. Thanks very much, Nick. We do have a number of questions coming through, which is great. The first question, can you and do you ever run the absolute return portfolio fully invested so you can capture markets when they're going up also?
Yes, it's a good question. So yes, we were fully invested. So people who saw us in February would know that the absolute return fund and the long only product were pretty much the same. They were both fully invested. In fact, I was probably one of the more bullish people out there at the start of this year. So yes, we do run it fully invested. Yes, we look to capture the upside. We're looking forward to capturing the upside of the next bull market. We're just saying it's probably time to be a little bit prudent. If we miss a little bit of the upside at the start here, that's fine. We're okay with that. But yes, we do run it fully invested, and it is our full intention to at some point in the future.
Okay, great. Just one on currency, Nick. How are you thinking about hedging in the low 60s, the $8 in the low 60s? At what point do you hedge the majority of the US dollar exposure?
Yeah, so thanks for the question. Look, currency is probably one of the things we haven't done well since the fund started. So we've run predominantly hedged, so 50% or more hedged since the fund started. And so I think I showed a 7% return from FX for the fund. The index actually has nearly a 20% return. So more than half the index gains over the period we've been running have come from currency. So we haven't captured as much as I would have liked. And that's mainly because we just don't feel like we have an edge there, and we don't like to have a 100% bet that the currency will fall. From our point of view, as the currency's down here, we have hedged a bit more. So we were running closer to 50% or 55% US dollars. We've moved it back to 35. And that's just a way of banking the absolute returns it was giving us through that period. Looking ahead, I'm not 100% sure it's bottomed here. But what I do know is over the last 25 years, the currency has added absolutely zero to your performance. It's gone nowhere. And so we are hoping to get some of that relative performance back, and more importantly, protect against the currency rising in the future with our absolute returns. So yeah, I think we'd probably be looking to hedge more as time goes on.
Okay, another question for you, Nick, on option hedging. Are you going to hedge again as the market rises in case of another leg down? Yeah,
so the bad news is we can, but they definitely will not work as well. So options work when volatility is low. Options don't work when volatility is high. So that's part of the reason, I suppose, why we're only just over 50% invested today, is because we do feel like there could be another leg down out there, but we can't really use options to hedge it anymore. They may work, but they just won't work as well. So from that point of view, we need to pick the right stocks here, which I think we have. And we just need to be a little bit prudent about how we put the capital back to work in case those downside legs down happen, and we can just buy more of the things we like when that does happen.
Okay. Well, Nick, I think we're just going through the questions now. There's quite a few questions, but they sort of all mould into those three main questions. So what I might do is, just watching time as well, might leave it there. I'll go through the questions after the call, and we can get back to you and answer some of the questions that we haven't got around to. But Nick, just yeah, once again, thanks very much for taking the time today to chat with our retail clients, which is great. Ladies and gentlemen, I might just say by thanking you all very much for taking the time to join us today. As I said at the start, the goal of the webinar was to ensure that you kept up to date with positioning within the fund. Having seen Munro manage the portfolio during what have been good times during a bull market, but also now during extremely difficult times in a bear market, hopefully it provides you with confidence and a higher level of conviction in Munro's stock picking and portfolio management capabilities. I think Nick made a couple of really important points during the presentation that I think are worth highlighting. For those of you who remember, since Munro started in 2016 and throughout the bull market, Nick has been telling us all, at some point, there will be another drawdown like we saw during the GFC. And like the GFC, we won't see it coming. And as Nick has pointed out a couple of times today, Munro did not see the pandemic coming. But the risk measures were already in place to deal with the extraordinary market conditions that we've witnessed. And effectively, these risk measures have allowed the fund to continue on its path towards delivering on its longer term objectives. At different times, this ongoing protection has come at the cost of some relative returns, but investors have been paid back in spades during this crisis. And Munro are now in enviable position as they look to take advantage of opportunities that exist in the equity market when that time is right. The second point I'd make quickly, and again, Nick has touched on this regarding currency, over the past 2 to 3 weeks as a result of where the $A sits today, I know many of you as advisors are starting to consider adding hedging back into your client portfolios. The menu of hedged managers, as we know, is quite limited. So the Munro Global Growth Fund, today being hedged 65% and actively managed, can play that role as your hedged global equity manager to complement your unhedged managers. Depending on your view, this may be worth some consideration. And finally, at GSFM, our job is to be there for you should you have any questions in relation to the Munro funds. So please don't hesitate to get in contact with your BDM should you have any questions or require any assistance. In the meantime, we'll continue to provide regular updates. Thank you again for your ongoing support of GSFM and Munro. Please take care, stay well, and we look forward to talking with you all again very soon. All the best. Thank you.